Hello, ladies and gentlemen, and welcome back. What a weekend. Does it look like 2008 again for markets around the world? Well, of course, with Credit Suisse, Deutsche Bank, and many others out there, people are starting to get concerned. However, it didn't stop the buyers coming in. And as we talked about on the weekend, the 200 simple moving average on the weekly held it again. This has been a zone that has held not only 2018, 2016, and 2011. And it's often been synonymous with the big turnaround. That is that the market actually has bottomed in those zones. But this time it is different. This time we need to look under the hood because what's going on in these markets right now is actually incredibly sick. However, so many people are bearish. We could have what they call a dead cat bounce or a squeeze rally on our hands. We have to be prepared for all situations as traders and investors. So let's take a look together now under the hood of these markets and cover stocks, commodities, and of course cryptos, because all these markets are interconnected. See you soon. This will be a good one. Well, welcome back everybody to the Daily Show where we discuss stocks, commodities, and cryptos daily. We talk about the key macro levels, which we'll discuss right now, the data that you need to know, and then of course we'll go into the charts and the lead indicators and all the levels that we're looking at. Credit Suisse's bonds hit record lows. Yeah, this has been the story now for realistically the last couple of days, and it reminds us all of Lehman Brothers, doesn't it? It reminds us all of Bear Stearns, the problems that happened in the GFC. What has happened though over recent weeks has been something we reported on the weekend, which was smart money and dumb money, an indicator that we sometimes use here, have converged. We've got a massive difference between what smart money is supposedly doing in this market and what dumb money is doing in this market. Often we are referred to, unfortunately, as retail traders as dumb money, but don't worry, many of us are becoming smarter thanks to the power of course, sharing and information online and people just really taking a huge interest in all of this stuff. So we've got a massive switch. Now we've seen this before. We've had huge differences between smart and dumb money before. And what has that meant? Well, when we tend to see these huge differences, we get some interesting statistics. In fact, when the indicator is above 50%, which it just happened, we generally see some incredible annualized returns. Now, we have seen this a few times over this particular period of 2022, but what has generally happened here has it's been a bounce, and the bounce has been relatively significant. Here's some stats behind what we've seen after these readings. 1 week, 2 week, 1 month later, into 2 months later, statistics would have you guess that there are some very decent returns that are potentially going to come into these markets. Look at the average percentages and then look at the percentage time positives. We have to be open to this idea even in the face of something that is terrifying. Now, why is that? Well, it's got to do with the extreme fear of everyone in the market. Here are pretty much 6 of the main leads that people use. Of course, we've got put call options, which many people are familiar with. Options make the markets go around, and we have a lot of puts built into this market right now. Basically, everyone's buying protection. We've talked about that many times. Market momentum, of course, is in extreme fear with a huge decline recently, and stock price strength is also very restricted. In fact, Nasdaq is looking very, very poorly up until 24 hours ago when it comes to how far down it has sold off. We also have the time of history here in 2022. We've also seen something that we've never seen before, 2 readings of 60% plus bearish from the sentiment surveys. These surveys go back to 1987, and we've never had that before. So history in the making in terms of how bearish everybody feels about these markets. And of course, rightfully so, we could have a global financial crisis on our hands that could shed a waterfall moment. And we'll talk about the synergies with this market in 2008 just very, very soon, because it's super important to understand. Options traders are spending bucket loads on protection. Here's just some stats we shared on the weekend. Again, getting up there with those extreme levels. We often saw turnarounds, at least temporarily, from these points. But do remember, when this happened in 2008, we saw some reprieve, but then we saw another really large fall off, like a watershed moment where markets just got destroyed after that. So a lot of people are discussing this particular chart and everyone's talking about Credit Suisse and of course the credit default swap rate. We're seeing it at 14-year highs. This is the same as what we saw, or very similar to what we saw in 2008. And realistically what this is a credit default swap is a derivative product which serves as a form of insurance against default of an underlying borrower or debt instrument. Basically, it means that they use this type of thing that allows investors to swap or offset their credit risk with another investor. Now, when these become really high, it shows you that there are warnings in the market. And of course, there are plenty of warnings out there in the markets right now. Here's just a quick chart actually showing you the price to book of a few major banks out there. These are getting very low, and it's telling you that investors and smart money probably doesn't want to hold the risk here. Who's going to have to step in? Well, my guess, and I think a lot of the market's guesses are that central banks will be forced to step in to protect the economies from collapsing. What a weird world. We're trying to combat inflation, but by combating inflation, we're destroying the market. And it's just, it is wild. If we get through this issue, I will caution everyone, truly, if we get through 2023 and we come out and markets start to reprieve, never forget what they're doing here. This will eventually bite us all. I am very confident in that. And the next crisis, if we do get through this one, because a lot of people are going to say this is it, but if we get through this one, the next crisis will be significant. They won't be able to protect it. One rule, if it comes from land, if it comes from the biggest asset class in the world, which is property, do be scared. At the moment, well, it's kind of a little bit more off in the kind of networks. It's not realistically coming from land, at least at this stage. So Credit Suisse, we can see here Deutsche, we can see a whole bunch of other banks all trading very, very low. If we scroll through, you'll notice that really that's what most people are looking at, but we can't really focus on that as investors just yet. We have to focus on the market being incredibly oversold and the price action. So we'll talk about that soon. Now, this is pivotal. Have we seen peaks in the 2-year yield? Well, we've certainly seen it drop over the last 24 hours. We've certainly seen it drop realistically over the last week. And remember, on average, 2-year yields peak around 1 to 1.5 months before the end of the hiking cycle from the Fed. So will this force the Fed to not hike as much? That's what some people are kind of starting to believe. Maybe the Fed's going to have to put a halt on it, as will central banks around the world. A great stat to remember in the back of your mind. 1 to 1.5 months before. Do also remember that Nasdaq 100, we saw the massive sell-off in tech recently, similar to the readings we got back in June and July, which stopped us and of course made a bullish kind of case for the markets. We are at a similar point. Usually, statistically, the next 1 to 2 weeks have been more positive than not, and we got this reading last week. At the same time, we're in US dollar extreme trend. Everybody would think, based on the media, that now is the time to buy the US dollar. Yeah, the time to buy the US dollar was a while ago. You can see the trend here, and we're only in the second week of this stat. We brought this up over a week ago, and so far, we have seen the US dollar struggle and start to move down. Remember, we're in a midterm election year. Often October brings the rally. During normal years, we see a little bit more weakness, and then we bring a rally. In both cases, though, generally there is some kind of reprieve into the end of the year. Maybe 2023 is where we see that waterfall moment if things get worse. These are the average over 200 plus years of data in terms of all the bear markets. And this is the one I wanted to get to. Now, if I update this chart, which I will do in the future, we are literally like this. It's uncanny. 2008 versus 2022 are so ridiculously correlated, it's almost terrifying. Now, if you think about it, what it's doing is not only do we have similar kinds of problems with Credit Suisse, etc., but we have a correlated market. Now, generally what happened after this period is we saw a small rally, and then we saw, of course, a watershed collapse. This is the watershed moment. Now, some of you will say, oh, we want this, we want this. I'm not too sure about that. That's actually very terrifying. But this is the type of thing that usually capitulates markets. So if we keep following this, if we keep pulling up here and we go to something like, let's say, a 3,900, and then we find some resistance there and some selling going on in that zone, could we be going into an absolute collapse in these markets? Be very careful here, guys. The next 1 month to 2 months is going to be pivotal to these markets. Now, I just wanted to show this one. I shared it on our Twitter. Follow at FX Evolution if you're interested. Now, a lot of people are calling October for Bitcoin, but notice the years that it's down typically in these periods. 2014, 2018, both crypto winters. 2022, what is this? It's a crypto winter. So just be a little bit careful here. I still think crypto, especially Bitcoin, could be falling into some percentages that we'll discuss later in today's video, what it's historically done. Here's a good little chart to have while we get into charts here, and we'll now go through all of course, the lead indicators, then the charts themselves. And this is Credit Suisse versus Deutsche. And you can see here they are horrible. They are both down heavily. But what's happened to Credit Suisse recently is it's made a new low and dropped significantly. If you compare this to where it was during the GFC, you can see both banks have actually been suffering for a very long time. It's not news to most people in the industry, but to a lot of people, they will have never looked at a Credit Suisse chart and they won't know that it's been declining, it's been looking unhealthy for years and years and years. This is when value goes wrong, and do not consider these types of things, at least in my opinion. The risks are great, and are the rewards worth it? You've got to question that. A lot of analysts are backing them, but realistically, we know that these times are perilous. We do have, of course, stocks, S&P 500 stocks above the 200-day average at lows here, significant points in markets. If you actually time these, you'll notice that a lot of the time when we get to these readings, whoop, that wasn't very straight, was it? We end up being at a little turnaround point. The only time I can think of that didn't happen was when we busted down through 2008, and then we actually did see some increase here. Then we saw a secondary drop, and of course it came through. So there was still a little bit of a reprieve when we hit these numbers. This is an extreme zone. It's worthwhile considering it. Now the VIX, was the VIX fearful? Usually you would see fear rising during these times. That is not what happened. The VIX actually dropped. Now at some point, I think most of us expect the VIX to go high. That is a 45 plus reading. Generally, most big falls drop or they go into maximum fear, and somewhere around that maximum fear, we see bottoms in markets. 2022 has been weird. They've thrown everything at the market, but the market will not go to maximum fear at this stage. I think a lot of that has to do with everybody believes the central banks are just around the corner to protect the markets. And the Bank of England stepped in the other day with, of course, the pension funds, and now people expect, of course, other central banks to step in with Credit Suisse. This is the problem, guys. Eventually, they won't be able to step in and protect it. You know, this is ridiculous. I think we all know this, and that's why so many people are in trading and in investing, because they want a better life. Like, let's be frank here. They have stuffed the system. I've said this for a long time. Eventually, it will completely explode, and it will be very bad. You cannot continue to do this. And the world works on one word: debt. Remember, to build growth, we haven't really been growing a lot of Western societies for a long time. It's debt that drives these economies significantly, and that's why during periods of fear, we see such huge problems. The debt is out of control, and eventually it will come home to roost, but property will still be the big one that we need to follow there. US two-year yield bonds, you can see here they dropped significantly. This is actually in line with what we discussed. This was the significant breakout the other day. It's pulled back, it's dropped off. This kind of bodes fairly well for the market in terms of being bullish. We also saw it with the US 10-year as well, and the 5-year. We see the 5-year here, we see the 10-year here, all dropping. But more significant is what's happened to the curve. So I'm going to show you April 2023. Here's April 2023, 4.4%. Only a few weeks ago it was at 4.75%. That's basically 2 rate cuts in terms of where the expectation is now of the market. The market's saying you're going to have to come in, Fed. You're not going to be allowed to go as high as you thought you would be. And then in December, we've got a 4.14. So now the yield curve looks like this, guys. It was like that until December. Now it looks like this. And it kind of drops off. So it's actually not going anywhere near as high. It's only going to maybe a 4.5% instead of 4.75, or even a 4.25 now. And then it's dropping by December. This is a big, significant change in the expectations of the markets, and that's why they're up. You look here at bonds, high yield bonds starting to go up a little bit here. Will they hold? I mean, again, this is based on, of course, their belief the Fed might step in at some point. Will they? We'll find out. LQD, corporate grade bonds. Of course, people didn't want the high grades, but they're buying a little bit in the corporate. I can tell you my lead bond indicator has had 3 decent sessions on it now. So it's front run a lot of this. And you've seen bonds turn last week, which is a very interesting point. We've got the treasuries here, the 20-year TLT coming off the demand. If yields do drop, what's going to do okay? Treasuries. But don't expect, a lot of people are trading treasuries right now. You cannot expect incredible returns out of treasuries. Yes, they've dropped a lot, but you're going to need a lot of rate cuts to get it back up to here. So you just got to remember that the one thing about these treasury bonds, if you do buy them, is they are slow. They are very, very, very different to the cryptos or the stocks or the commodities that you're used to. Let's talk about US dollar before we go any further. Now, we've seen those stats that showed us that US dollar was weakening a little bit. We saw the change that happened here. Once it broke through this demand zone, we saw the pullback. Obviously, we liked the idea that it was coming down. I still would really like it to come into this demand box. And you can see here a 200 simple moving average, I believe, that's on this 2-hour chart, or 3-hour chart. But more significantly, we will need to see a new low here on the dollar. So you don't want to go above 112 kind of 60, and you want it to see it kind of fall further off. If it falls further off, that will be a bit of a tick for the stock markets around the world. It'll show that maybe there's a little bit of, I guess you would say, risk coming back on. Now, the next 24 hours, though, could be a little bit different. I have a suspicion that maybe stocks might drop a little bit here, giving up some of it, and then we'll find out whether it's actually willing to turn. Let's talk about gold. You can see here, gold, we had two supply zones. We got that initial reaction to this supply, and we got this secondary zone we just came into, and it's rejecting that level. This was a significant break previously. Now, gold, for it to go down, of course, US dollar will most likely go up for now. And we've got a little bit of room here, as we saw with US dollar, for it to significantly go up over the next 24 hours. So we'd like to see gold probably pull back down now, maybe find some buys around the 1680, or even go a little bit lower into the 1660. Those two levels hopefully will hold some buyers, because gold broke through a fairly significant level over the last 24 hours. It's now at roll reversal, supply, all sorts of issues for gold at this zone. Now, a lot of people are mentioning silver as well. I haven't been putting silver on the charts as much. They're saying this looks like a base, Tom. What do you guys think? Yeah, I do think it looks very basey until you get through this highlighted area up here, which was a significant level. I don't think you can really bet on silver. But the reason why people are talking about silver, guys, has to do with its switch. You'll notice the dates down here. The 16th of March, the 23rd of March. Silver moved early. And a lot of people say silver bottoms first and silver turns because it's a used metal. It's a precious metal as well. And yeah, it is basing. It does have a very strong demand level here around that 18. You can see the nice bullish hammer that's come through from it. And it looks like it's forming potentially a Wyckoff base. So how this plays out, more importantly, how it gets through here, is going to be significant. Be very careful around this 2180 zone. I think that's going to be very significant for silver, and it most likely holds some bears in it. Oil is similar. Oil rallied fairly significantly over the last 2 days. We're coming into that big supply issue. Resistance is here around 86, so oil could continue to drop. And I still think oil, longer term, my still approach to oil is, get it back into the 75s or even the 65, and I'm still aiming for that long term. Now, here's where things get really weird. Tesla's playing catch up. All of a sudden, we get the news, and Tesla just gets destroyed. Now, it missed marginally. A lot of people were having a debate with me about this yesterday. And basically, the stock got punished. 8.6% down. It went through that key level. We reported on this on the weekend. We discussed the fact that this looked really bad for it. And we kind of had these two levels in our minds. Now, it touched the first zone, touched the gap close, which was here. And then it went down to this little miniature demand near the close. Now, wasn't a wick. We didn't see buying into the close, really. We just saw it go straight down. If you're thinking of this as double top, you'd go A equals B, which would push us to a 220. And 220 is where the real buyers have been in the past for Tesla. Yeah, it's a significant drop off. It's a significant gap that's been left behind. So you would want to make sure you have that one labeled on your charts. And we're in the first level of potential demand. However, I do feel like Tesla probably will drop a little bit and punish some buyers because a lot of retail will have bought into AI Day. They get hyped. I know a lot of you Tesla guys out there get hyped and ready for it. You're used to like big rallies off these events. And I think the market was waiting for that to punish and unfortunately cripple a lot of people with a significant downside. Remember, from this level here, all the way down, you're talking about still a 16-17% downfall. That's a lot of percentage. And yeah, at these levels, though, we've seen strong buys in the past. Realistically, volume has also dropped fairly significantly off on these days. Apple did bounce, not quite off the level we'd hoped for here again. So it just kind of bounced. I think it's in the middle of nowhere zone for now. So we'll come back to Apple in the future. Big volume though, which is notable. Now, why could the market go down a little bit? Well, let's have a look here at Exhibit A, Microsoft. Microsoft has gone underneath the previous low here that was formed in May of 21. Now, I've talked about this a lot, a trend line that goes from previous history all the way through. So this is the one that takes the lows of the pandemic, the lows of 2018 crash, and we also see that previous demand, previous supply, resistance, support area. All of those coincide with the 225. So are these markets showing us where the market really wants to go? It's not just this market. We've got AMD, if you load it up onto a chart. You've got semiconductors that could drop into other lows. Remember, they've just taken those points, filled the gap here. The semiconductors looking quite weak. They're coming up, sure, big rally, but they're right at that point of, massive potential of turnaround. You've got to be very careful around this. Let's look at the S&P 500 very soon to discuss it. UK 100, the FTSE, key demand. This is a super level. Think about that as a giant Wyckoff pattern. It's a massive distribution. We've got alerts set underneath here just in case. I mean, that's a horror show if it takes out the lows. I mean, how low could it go? Certainly, it's holding itself as best it can. But notice the difference. Here's a close down, wick, 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 wick. What's that telling us? The buyers were very committed here. This is a super question mark at this point on the UK. We'll go to the DAX. The DAX is recovering, but again, it's just recovering back into where it broke out. Previous kind of issues. I could see the DAX even do this and then that. So you've got to be very careful here in the DAX because realistically, these are the lows that it seems like it wants to go towards, 11,500. And it's another warning sign here in the European markets. Let's have a look now at the US 100, the Nasdaq. We have a gap that's not filled perfectly from 10,967-ish. And we have a market that has gone through the first level of supply, and you'll see it just tapped into this second one. And now it's selling off at the time of this video. I'm going to go into the smaller time frames. Let's go in the 15-minute for a second and just look at the next 24 hours. Notice the buying that's happened here and here. This will be a significant drop. So if it goes underneath 11.2, you'd probably expect it to pull back slightly and then drop off. That's going to be a fairly important intraday level that some people may want to focus on and consider what they do next. Of course, you've got to make your own decisions. This is just theoreticals here on these markets. We do have also some very key previous supply up here. So if we do end up going higher and higher and higher, is this the turnaround? Above here is super significant, and we'll talk about that should it happen. But at this stage, I would feel like that rally was very quick, it was very fast, and you could see that it might want to do some trap. This is like a giant kangaroo market of, very scary, very sharp, fast, nimble trading needs to be done. As we mentioned, the S&P 500 is on the 200 simple moving average on the weekly. It's a key level. Let's have a look underneath the hood. So we have a gap that hasn't been filled at 35.85 from the Friday close. We have an incredible rally through this market. And of course, we've seen it take out this first level of supply and break through this trend line. Okay, it broke through that trend line. We talked about it on the live stream. It didn't even, it kind of found a little bit of selling here. It didn't even do the proper turnaround story. Again, that's the level here. That is the price of what, 3673. I'd like to see it take that, bounce a little bit, and then fall off. We've just hit the secondary supply, and the big kahuna sits at 3730 or 3720.30. So 2030, that's the huge supply. If it gets in here and it busts it, we'll have to have a different discussion about potential pullback recoveries. But at this stage, we could see sellers in either this zone or this zone. You've got to be very open to the idea that there could be sellers coming in after that big rally off the 200. In terms of options, there's just not that much happening this week. It's very thin. You can see here, open interest amount sucks, so we're not really going to pay too much attention to that. By the 7th here, you're talking about a 380 max pain. Will it happen? Some notable kind of levels. 350 and 355, but I just don't think the options change. That's interesting. And just remember with crypto, it's still incredibly weak. Look at this daily. It's not coming with the stock market. Look, every single time it's hit this level, it's had some issues. If we break underneath, and you'll see I've got a little alert here, if we honestly get underneath here, it could be a absolute watershed moment for crypto. I'm not sure how much demand will sit through some of these levels down here. And every other crypto crash, that is every other one, has gone between two levels, 83% down and 86% down. So 83% brings you to 11.5, 86% brings you to 9.5. In this area here is previous demand, previous issues. So yeah, there's significant issues here for crypto in the future. Be very careful, I think, in this market, depending on what you're doing. And of course, be nimble and fast. Practice patience, react to predict if possible around these levels. If you haven't already, come and follow us at FX Evolution on Twitter. We share a whole bunch of charts on there. Obviously, we have a Discord as well, which you can join. The link's down below. If you're interested in more things about the news, get an economic calendar. Here we've got one, and you can see that we've got some information coming out. Let's have a look here. Tuesday, 4th of October, we've got JOLTS, job openings. We've got some interesting information coming out from ISM Services PMI at 10 a.m. on Wednesday. And then the big one is at the end of the week, the non-farm payrolls number. Now that's expected, if you can see here, to show a little bit less in terms of the jobs, 265K. Let's find out how that plays, because how this plays may have a lot of bearing, and possibly the market might want to see a bad result. And that's going to show us that the companies are tightening up the labor force, which usually means that demand destruction is underway, and maybe the Fed doesn't have to go that much higher on rates. It's a weird world out there, guys. 2022, bad news is good news is bad news. I mean, what ridiculousness do we live in? But if you want to find out more on the daily about what we cover here on the markets, remember to subscribe, smash that like button, and we'll see you in the next one. Thanks so much for watching, everybody. Bye for now.